Hi, Chris East here at East Partners. Thanks for joining me for this quick video on our overview of the 2026 federal budget. This presentation today, this is in conjunction with the paper that we put out yesterday, being Wednesday, the written document, which will also be linked to this video, which you can access if you haven't seen it. Essentially today, I'll be covering part of the budget and probably the parts that I think are most relevant for you and our client base, which primarily covers off the permanent instant asset write-off for small business, the new instant work-related tax deductions, changes to capital gains tax, changes to negative gearing, and the proposed tax of discretionary trust distributions, which I've just put up on the screen there. All right, so as a starting point, what's the government trying to achieve here? Well, they say they're trying to achieve cost of living relief. Believe that, if you will. They're certainly targeting things around housing affordability. They use tax reform. My view on that's very different. Those of you that know me know that I don't necessarily subscribe to some of the things that they do call reform. Reducing reliance on investment tax concessions, that's pretty evident, as you may well already be aware, and looking to try and encourage some business investment. All right, so if we take a look first up, those of you that are in business, those of you that have run small business for a period of time, you would most likely be aware that the $20,000 instant asset write-off has been a temporary thing. It's been reviewed each year. It's been renewed each year. The last couple of years, the renewal of the $20,000 write-off has come late in the financial year, which has made it very difficult to obviously plan for capital investment. The good news is that they have finally made it permanent. Applies to businesses with turnover of under $10 million. The immediate deduction is for eligible assets under 20,000. The idea is that it will improve small business cash flow, and by that you get the immediate write-off, which you can claim on tax, reduces your tax burden, and in turn means that there's more cash in the business to be able to fund its operations. So whilst not necessarily a change as such, it's certainly something that is now permanent and is no longer a temporary measure. So from our perspective, that's a good thing. So moving on to the instant work deduction, this is going to be a standard $1,000 tax deduction that will be able to be claimed in tax returns without the need for record-keeping requirements as they currently stand. Now, this won't apply to all sorts of deductions, things like donations, things like vehicle costs, union fees, and a few other things that they've outlined in the budget papers they'll fall outside of the standard deduction. As we go forward, there'll be a little bit more detail around what exactly that will cover. At the moment, I'm not too sure whether the various changes to home office claims over the last few years will be set aside and covered under this deduction. We'll need to see. But the idea of it is to try and simplify some of the record keeping around work-related deductions. For some, it will be of some value. For others, it won't make any difference because work-related deductions are naturally higher already. So it will really be determined by individual circumstance. But overall, I think it's a bit of a positive. The other part of this is the worker tax offset. This is a $250 tax offset. A little disappointing that it's not going to come in until the 27-28 financial year. It's also coinciding with some slight reductions in marginal tax rates, predominantly at the lower end, with the current 16% rate under 45,000 dropping to 15 and then to 14 over subsequent years. Personally, I think at the moment, a lot of people are hurting with just, life. It's got very expensive. So for it to be delayed, really, people won't see any benefit of that. You won't see any benefit in that until you're doing your 28 tax return. So that's the subsequent year. We're talking several years away at this point. So whilst it is an initiative, I think the timing is not going to help anyone, really. So just my thinking around that. All right, moving on to some of the more meaty stuff. Changes to capital gains tax. This was mooted prior to the budget being released. It's a substantial reform to capital gains tax. I remember in my early days of these partners in the late 90s when the proposal to remove indexation and replace it with the 50% discount was introduced. It was a substantial investment at that time and quite a simple reform at that time. We now are over 25 years on, and personally, I think this reform is overdue. The means by which it's been implemented is going to be somewhat complex, particularly around time. It's not going to be starting until 1 July 27, so there is time to look to potentially restructure arrangements if appropriate. And then there'll be a grandfathering model with the current 50% discount and the introduction of the indexation model. The real takeaway, though, on this, apart from the change and the timing, is that if there is a capital gain that is realised post 1 July 27, is that there'll be a 30% minimum tax payable on that capital gain, regardless of what marginal tax rates are. So just on my very initial calculations on a couple of scenarios, I can see where that capital gains tax treatment will be worse off for some people. Others, whilst not necessarily beneficial because there'll be top up if your effective rate is greater than 30%, but it perhaps will bring into some question around how best to structure assets, certainly moving forward. Those that are already structured, restructuring costs could be prohibitive, but the treatment around capital gains and the associated tax on it is certainly going to be looking quite different. It applies across all investment classes. It's not just property. That's been the government's focus, but it extends beyond property to things like shares, crypto assets, and other investment structures. So it's certainly going to have impacts on the decisions around not just investing in those areas, but certainly on how they may be held in terms of structure. There are some carve-outs depending on some of the structures as well. Also, not so much carve-outs, but there is some different treatments, superannuation and so forth. Anyway, flagging that there's more information in the paper that we've put together, and as things develop, we'll be keeping you informed. The next part is negative gearing changes. Again, fairly substantial, starting from 1 July 27. This really is aimed at winding back some of the concessions that apply to negative gearing. Similar to the capital gains tax changes, there will be some grandfathering around this. There is a carve-out also, so I should say a limitation to the benefits of negative gearing that primarily relate to the construction of new builds. Now, I don't know what new builds means at this point. That hasn't been defined in legislation. That will obviously come in time. But I think the intention is to say if you're looking to invest in property, it's a new construction that you then are renting. You'll then get some effectively the same negative gearing treatments as we have now. For others, where things are in place, they will continue. There won't be necessarily anything changing on that immediately, but certainly for other assets that are purchased going forward, the treatment of negative gearing, primarily the deductions, will change. And very simply, it will say that if you make a loss on the asset that you've negatively geared, that loss won't be able to be offset against other income, but instead will carry forward until such time that either the income produced from the property is positive, that is, the debt gets paid down or whatever, or the property is sold, and then those carry forward losses can be used in the capital gain calculation. The idea is to discourage the purchase of property assets for rental. Look, what that's really going to look like in practice, time will tell. But I certainly think that with the negative gearing changes combined with the capital gains changes, it's not going to make property as attractive perhaps as it has been, notwithstanding the entry costs into property are already enormous. So that's already a disincentive for a lot of people as well. All right, so moving on to changes in discretionary trusts and other forms of trusts. This really surprised a lot of people within certainly my profession and arguably the broader market. What this is effectively saying is that if you have a business that operates through a discretionary trust or a unit trust for that matter, if you have property held in a discretionary trust or a unit trust, at present, those distributions are paid out to beneficiaries. Beneficiaries may be on lower tax brackets. You have some flexibility around who you distribute to get some tax efficiency. Now, this is going to put a flat tax, 30% on the profits that the trust makes. So if the trust makes $100, the trust will be paying 30% tax on that. So $30 of tax gets paid. The money is distributed out. So let's say the $100 goes to a beneficiary. The beneficiary will pay tax on that $100 less the $30 credit that's for the tax that's already been paid. The practicality of this is that this will have a major impact on who receives trust distributions. The ability to be able to distribute to lower tax beneficiaries going forward is going to be certainly it's going to be compromised, in my view. Distributions out to, let's say, corporate beneficiaries, which a number of clients do. I think that this tax will more or less end that. It just will not be effective to do that. There is no doubt where assets are held in trusts, they may not have the same appeal as they had previously. However, in some instances, the restructuring costs of possibly adjusting the holding of that asset could be prohibitive. Capital gains stamp duty and so forth, I think for a lot of people is going to not be a great thing. However, I think where you have assets in trusts, and if you are concerned or whatever, then I guess watch this space. And by all means, let's have a conversation, which then dovetails nicely to what should we be doing. The most important thing I would be saying is do not panic or rush any decisions. I've seen over time, I've been doing this a long time now, and I've seen where there's been government announcements, there is a component of people that will panic and will look to sell down assets or make rash decisions or whatever. Now, there is no legislation in place yet. These are announcements. These are plans of what the government proposes. The reality is that they need to introduce legislation. It needs to be passed. It needs to be passed by both houses in the format it is in. Once we have legislation and we know what it looks like, because these things can very well change, then we're in a position where we can rationally consider strategies that are available. And as I've said throughout this quick presentation, there is a bit of lead time with this stuff. But that doesn't stop us being able to have a conversation then. So if you are concerned, by all means, let's have a chat. Structures will need to be reviewed. We'll be looking to proactively review structures with all clients over the coming months. Certainly as we get more guidance from government as to how these announcements will operate, obviously through legislation. It will certainly have impacts on investment strategy considerations. So those are practical issues. The longer this takes to get clarity around investment decisions are going to be delayed. That's unfortunately going to be part of the reality. Hopefully we get some clarity relatively quickly so that we are able to move forward with confidence. These are tax changes. Tax never precedes cash flow. Cash flow always is at the top of the tree. And for those of you that I've worked with for a period of time, you will know that's exactly my thought on that. Cash is king, but we need to still make sure that we are also giving consideration to our tax position. And obviously seek advice before restructuring. Don't charge off and do everything. As I said, don't panic. Don't make any rushed decisions. Don't make any rash decisions. We're here to help. And these changes, the most significant changes I've seen in a long time, certainly been some big changes around subsets of the economy and investment sectors, superannuation being one that's had lots of reform lots of change, I should say, over the years. But this is pretty far reaching and will touch a lot of people. So as I said, this is a major shift in policy by this government. Seeking advice is going to be absolutely critical. All right. If you've stayed this long, thanks so much for joining me today. I hope this has been of value and I look forward to engaging with you again soon.